Hello, everyone, and welcome to Real Estate Right Now, where we talk about real estate matters that matter to you. My name is Jay Izzo, and we have an outstanding show for you, as we always do. I'm back with Paul Fitz, Senior Loan Officer with Advantage Lending here in Raleigh, North Carolina. Let me ask you a question. Not you, them.
Wait a second. This isn't the fantasy football show?
It's not the fantasy football show.
Oh,
So let me
wrong
ask you,
show.
let me ask all of you a question out there who are listening, watching us, wherever you're watching us from, DBTV, by the way. Saturday mornings, DBTV, 8:30 a.m. You can watch us on your Roku and Fire Stick devices. Just download the app, DBTV. And you can watch us at 8:30 in the morning. So I want to ask all of you out there, are you interested in saving money? I think the answer is yes. I think that is the answer everywhere is save money. And if you're looking at buying a home, right, purchase, you're probably wondering with these interest rates, how in the world can I save money now? Well, it may not be now, but there is a route to get there.
Yeah.
And it's understanding the rate market and what's really going on. And this is why my guest, Paul Fitz, who with Advantage Lending, why he's such an expert in this area. First of all, he's a data-driven guy. I mean, he's been on here with charts and graphs and has shown us all sorts of things. But today he's going to help us understand a question that maybe some people have asked: is this interest rate market artificially inflated? And what does that mean for me? Well, we're going to talk about that. So, Paul, welcome back to the show.
Thank you, bro.
Good to see you, man.
Good to be here.
All right. So, this interest rate market is kind of nutsy.
Yeah.
And it's we keep saying, we've said it over again. Well, at some time,
Eventually,
these rates are going to go down. And you know, we've said it probably ad nauseum. I mean, people do not want to hear it anymore. Date the rate, and we're ad nauseum.
how many different lenders have you had on? We've all talked. All of us lenders, we talk about this.
Same thing. I've had all four. Yeah. I've had four.
Yeah.
And you've all said the same thing, right?
Yeah.
But I think we don't understand. And we've also said, here's another one that you've all said. Whenever the Fed raises the rate, the interest rate's already baked in.
We knew it in advance.
Right. We knew in advance.
Yeah.
But the interest rate, and that whenever the Fed raises rate, it doesn't necessarily mean that interest rates have to rise.
Well, I call it the Rain Man effect. You know,
Okay.
hot water burn baby. You know, as soon as somebody hears the Fed, hot water burn baby, rates are going up. I mean, it's instant freak out mode.
Right.
And like everything,
right,
the Fed is a contributor. It's a factor.
Right.
But that doesn't mean that the Fed is raising mortgage rates and interest rates, and people still just because they hear a blurb on the news or TV. Right before I lock in a loan on somebody, oh, I heard they're going to raise rates again. I'm like, well, where did you hear it? I didn't even hear it. Why? How did you hear it? You know? So
we get a lot of information that comes across and then
conflated.
And it's conflated. And then the other thing is, whenever we hear that the Fed is going to raise an interest rate, we immediately jump to what affects us, especially as a home buyer. We're immediately jumping to, well, if the Fed's going to raise rate, that means my interest rates are going to immediately go up.
That's what everybody, I mean, honestly, it's an assumption of 95% of the market right off the bat. There's a very few clients that we would have and say, yeah, I know what's going on in the market, you know.
So we've been in other time periods where we've had high interest rates, and we've had time periods there's been low interest rates. What makes this interest rate market maybe a little bit different than some of the other time periods?
Okay, so good question, because if you're asking me and you're asking my opinion,
sure,
I feel like rates are a little artificially higher now than they would be in a normalized market.
Okay. Whoa. Okay.
Normalized market.
Yeah. No, not normalized market. That's not what's disturbing me. What's disturbing me is when you say artificial.
Yeah.
Because when I think of artificial, the first thing that comes into my mind is my artificial Christmas tree, right? Which is not real.
It's not.
It's not real. It is convenient.
Yeah.
But it's not real.
Okay.
So help us understand, when you say artificial rate, what are you really saying there?
So you're again, what Jay stated earlier, I'm a data driven person. Charts, graphs, I I've studied this market. I've studied markets. Again, I've brought in an interest rate chart that's 200 years long.
Right.
I study the markets. One thing that I have studied over the last 24 years of my career is there's been a normal spread that we would use as a barometer to say, hey, 10-year treasury note is here, it's X. Let's say 2% as a number. I'm using round figures. So if the 10-year treasury was at 2%, we would normally just bake in a 1.75 to 2% spread on top of that.
Okay.
And your normal 30-year fix would be 4% at that point. Okay. That spread was correct and consistent until December of 2021. And then the yield spread broadened a little bit.
So what is the treasury note at now?
I think the 10-year treasury note today was somewhere around 4.1, 4.8, somewhere 4.08.
Okay, so if we're using your mathematics,
correct.
So we're somewhere between what, maybe 5.5?
No, so it would probably be anywhere between 5.875 or maybe 6 1/8.
Okay,
would be what the normal interest rate is.
Okay.
However, today
we're
7.625, 7.75 on a 30-year fix. Correct. Yeah.
Right.
I hate to say this, and Jay knows I'm a little bit of a political animal as well. There has been some politics involved in mortgage rates. Months ago, the White House announced that they were putting a little bit more yield spread on top of people who were paying their bills on time. So if you had a 700 or 720 credit score, you're going to pay a little bit higher rate than the person who's got the 620 or 640 score. That is a factor that's involved now.
So that is really true.
It's real.
So that's something that you've seen.
It's real. It's baked in. It's all part of the.
So
but that's not all of it. But yeah.
Yeah. So if you got a higher credit score,
if you pay your bills on time,
and you pay your bills on time, you do everything right,
you're penalized.
You're going to pay a higher interest rate.
If you earn more money on your taxes every year, you're going to pay a higher tax rate.
Okay.
If you're achieving and you're accomplishing,
okay,
you're going to help subsidize somebody else.
So I've read this, I heard this, and of course, I don't believe everything I read in here.
Yeah.
But I will believe you if you tell me that this is what's legitimately happening too.
The moon is made of blue cheese.
I mean, is that if that's legitimately something you're dealing with?
Right.
Right.
Oh yeah, that's part of it.
Okay.
Yeah.
All right. So
the bigger part.
So the artificial piece.
Yep.
Now. So what the artificial piece of this then is that we've got this treasury yield.
Yep.
And it's at this particular percentage.
Yep.
The 10-year
treasury
bond. We add 1.7.
It's a great barometer.
Okay. We add 1.7 technically or traditionally.
2%. Let's go high.
Okay. So if it's 4%, 6.
All right.
Okay. So now you're saying though we're at 7 in
probably today 7.625.
So now we're at 3.6.
3, yeah.
If we're at 4, we're at 3.6.
Might as well just call it 3.5, 3.5 plus now. Based on what it should have been normally, another 1.5 is baked in.
So why do we raise that? Why is that now bigger than the traditional 1.7?
So based on how I've been looking at balance sheets and balance books for mortgage servicers. And by the way, if you guys don't understand how it all works, I do your loan. Your loan is $500,000. I do your loan and 10 of your neighbors' loans. And then we take all of this money in blocks and we sell it to a big company. And that big company is somebody we call a servicer. Okay. At the end of the day, the servicers are the ones who tell us what interest rates we're selling that day. They're like, hey, by the way, if you want to sell a loan to us, it's going to be 7.75 for you today. Okay. I mean, all we're doing is pushing the paper at the end of the day.
Right.
So in saying all of this, this means that, if you look at the balance sheets on servicers, they're making a lot of money on the back end right now. They've inflated the rates so they can make more cash flow. Their fear when they started this was that the economy was going to be way worse.
Okay.
In the very beginning. They're like, We don't want to lay people off. We don't want to let people go.
Right.
We've got shareholders, stockholders. We've got a lot of people we answer to.
Right.
We need to bake in something to make sure that we're still here servicing your loan.
Right.
So there's no apocalypse.
So then we inflate that rate.
Yeah.
Now, when they inflate that rate, that means for you as a lending institution,
Correct.
Right? That means that you have to raise your rate.
Well, yeah, we're selling the rate that they give us. So
you're selling their rate.
Yep.
It's not you. So I think this is a really important distinction.
It's not me.
I think that's
if it were up to me.
Yeah, right. Well, I think that's an important distinction.
Correct.
Because
but it's all of us. Anybody who's in the Freddie Mac, Fannie Mae realm,
right.
we're all affected by this. All of us lenders, we're at the end of the day, we're compliance officers really working for the federal government at the end of the day, putting loans into servicing companies.
Yeah, but I think for the consumer though, I think because you're the first person they see, and we always kick the first person we see, is they want to blame the mortgage lender.
Sure.
Right. I mean, because they want to go, well, it's the mortgage company that's making
the mortgage company's screwing me on this.
It's taking me to the cleaners on this.
But they don't understand all the other factors involved.
But they don't understand it's the service company that's really setting the.
In this case, it's the government and the service company,
and they're setting the bar.
Yeah,
and then you just can deliver whatever the bar is set at.
Correct. That's what we all do. And all of us lenders do the same thing.
See, this is really important, because I really don't think the general public, really understands.
They still blame us for 2008.
Right.
They don't even know the government was involved in that.
Right. But I mean, but the servicing institutions, right. You're the first person that's been on the show that's ever talked about a servicing institution as having anything to do with the rates.
That's where the money comes from.
Right, but it's where the money ultimately comes from that you get to in order to service people's loans.
Correct. Hey, at the end of the day, and I keep using the words Freddie Mac and Fannie Mae, those are still government-based. They were created as government-based entities.
Right.
The Freddie and Fannie government names, Sally Mae. I mean, we can go down the list of every, government formed entity, even though it's supposed to be kind of, if you want to call it a private public, shared entity.
Right.
But still, I mean, these are government-backed service loans.
Okay. So this is really good information. And so, all right. So now we know that we've got this artificially inflated rate. All right. And one of the things that we made a claim at the beginning of the show is, do you want to save money?
I want to save money.
Yeah, I want to save money too. Yeah. Right.
If I want to make money, I want to save money.
Right. I mean, there's right.
Yep.
Right. I remember, the old saying, it says, listen, every dollar that you save is not a dollar that you have to make. Right?
Correct.
Right. So now, based on what you see in our market and based on understanding how the service institutions mess with the rates as well as the government, where is for the consumer, where is this money potential savings coming from?
It's the future. I mean, it is the future.
Okay.
And I'm sure ad nauseum, other lenders who have been here, as well as myself, we've told everybody now's the perfect time to buy a house, because if you view a year and a half ago, and it always depends on the market in which you live in, because not every market is the same, but the market we live in here, the Raleigh market, is literally one of the hottest markets in the entire nation.
It is.
So in saying that, because this market is going to continue with the pace of people that are coming here, the influx of humans who are coming here, our market is still stable and will be stable and growing for a significant period of time.
Yeah, an unknown significant period of time. Yeah.
So to say that, if you view what happened a year and a half, 2 years ago with the massive bid wars that we had on properties, people, hey, I'm going to bid $100,000 over asking price on this particular property. They were justifying it because rates were 3%.
Right.
They could just, hey, it's not this painful for me.
Right.
I'll go $100,000 over.
Right.
Well, now we don't have all of these bid wars. And again, I know we've all talked about this. Right. We don't have the bid wars anymore.
Right.
But the hope for you, for the buyer, is to understand that the future of rates is not going to 20%. It's not going to 17%.
Right.
We're not seeing the 1980s that are going to happen all over again. It's not going to happen.
Right.
For them to understand that purchasing now saves you potentially $100,000 by not having to, bid over asking price on a property, saves you that money now. Plus the fact that you have, you're feeling a higher rate, a higher payment now. You know that you'll get a lower payment later when you get to refinance.
Right.
Based on how we've looked at models going forward, not next year, but as the inflation drops, as the market heals a little bit better, there will be some unemployment going forward in the future. When you factor, and you've got an election, by the way, there's an election coming up next year. This is 2023.
Right.
November 24, interest rates will not be this high.
Yeah.
You don't have to have a crystal ball and read tea leaves to know that in a presidential election, after such high inflation that we had, that interest rates are going to be 7.5% going in, because no president wants to be elected at 2.5 on the interest rate and then have his reelection at 7.5.
Right.
There's a lot of angry people going to the polls at that point.
At the same time, though, right? I mean, you're not going to see us go from 7.5 to 2.5 by the election.
No, not even close. No, next year at this time, rates could probably be in the high fives, low sixes. It really depends on how the market works going forward. There's a lot of normalizing going on in our economy again. COVID did a lot of damage to our supply chains, everything. Finding our legs again in our economy is what will stabilize and normalize and bring interest rates back down. Traditionally speaking, if you look at the 200-year chart of interest rates are generally lower than 6%. Right. 6, 5.5, those are normal rates. So.
Yeah. Okay, so I'm thinking through this then. So what would be a reason or a cause for these servicing institutions to want to make that spread a little bit lighter? What would be a cause for them to maybe change that?
So then when it's always the same.
Because there's room. Because what you just described to me is we've got room where we could actually bring these down.
Yeah. Oh yeah. We can bring them down. I'm more of a McDonald's philosophy. McDonald's doesn't have the greatest.
I don't know this philosophy.
Hang on. McDonald's doesn't have the greatest hamburger in the world, but they've served billions. They have volume. Right. Most free market societies, you want to sell in volume. That's where you make money.
Right.
And again, I think because servicers were feeling that this economy was going to be worse than it is, I think they were baking it in advance to prepare for the worst case. I think they were trying to not just protect themselves, but I'm saying they had employees, they had staff. They were trying to think of the future.
Right. But okay, but we do feel, and maybe I'm wrong, maybe I'm misjudging the markets, but I'm feeling like we're actually far more stable than we've been.
For the most part. We're going to have an unemployment phase come up soon too.
Right.
Yeah.
Right. And okay, so taking that into account too, which by the way, it seems that when we have unemployment, we also see interest rates drop.
Yeah.
As well, by the way.
Yeah.
Right. I mean, it seems to just go hand in hand, right?
Yeah.
Higher unemployment, lower interest rates.
Right.
So I know it's a crazy topsy-turvy world when you start thinking about it.
It's a witch's brew.
Yeah, when you start thinking about it. So, but is there something, what would be that trigger for the servicing institutions to say, you know what, we do have some flexibility here. You know what, this is our trigger. Let's go ahead and let's pull it back.
But they'll look at their balance sheets. They'll look at their staff. They'll look at their business models going forward.
Right.
And then they'll say, all right. And it's not like there's no way in the world there could be a collusion between them. They're all competitors at the end of the day.
Right.
Somebody's going to say, you know what? We want a little more volume. Going back to the McDonald's philosophy.
Right.
We want a little bit more volume. And when somebody wants a little bit more volume, all of a sudden you start seeing, wow, this servicer over here, he's a full quarter point lower than this guy over here. And all of a sudden the competition kicks in. And that's when you see the market, again, rates will come down and they will be a little bit aggressive towards each other to do it.
Okay. So this is basically an old-fashioned gas war. At one point in my life, there was a gas war, right? Where all of a sudden you would see gas stations lower by a penny, and
two guys across the street,
right, yeah, and they would start lowering. You'd see a penny each, right? And they would start.
Well, that's how they started raising it to start with. Dude across the street, his gas is $3.29.
Yeah.
Mine is $3.26. Maybe I can be the same as him.
Right.
Yeah, I mean it's the exact same thing. Okay. Turf wars always exist that way.
So the service institutions work very similarly. So, but who's gonna? I mean, who's
going to be the first one?
I mean, and why would they be the first one? What is it that's going to trigger them to do that?
Somebody's going to say, we got a lot of money on our balance sheet. We can afford to be a little loose right now. And the minute they decide they're going to be a little loose, bam.
Well, the average consumer who's watching this show, right, is probably screaming probably at us right now, saying,
"Why? We're giving you free future advice."
No. They're not screaming at us, but they're screaming back, going, "Well, of course they got a ton of money. Why aren't they starting this now? What are they waiting for?"
Everybody has their reasons. Why was eggs, $4 for a dozen?
Oh no. Organic eggs were almost $10 a dozen at Harris Teeter.
They were 10, all right, let's just say a dozen eggs 8 months ago or 6 months ago. A dozen eggs were probably $3, right? Well, now what are they?
I think I paid $5 or something like that.
Really? No, I mean, I went in the other day. I was like
organic eggs were like $5.
Sorry.
Yeah.
I go to Walmart to shop. I mean, I don't.
Because because I remember there was a time, and I was on LinkedIn.
Yeah.
And somebody was saying, "Oh, there's no place that eggs are $10." Because somebody said eggs are like $10 a dozen.
Yeah.
And there was this guy who was saying, "No, they're not. It's never been that high." So I literally went to the local store, right? I took a picture of the organic eggs, $9.99.
Right.
And I posted the picture, and the guy said, "I don't believe it." And I'm going, it's right here. But I mean,
it's proven the point,
right?
Yeah, but I mean, it proves the point. So in other words, when a supplier, an egg supplier, says, "Okay, no, I've normalized what I have in my bounty. Right. I've got X here that I can now bring down the price. Oh, well, this dude did it." And okay, Walmart did. I'm sorry, not the $10 people that Jay shops at, but the Walmart people brought their eggs down to $150 for a dozen, and now the Food Lion guys are now $139 for a dozen. I mean, again, it's the same thing. Once they feel like their supply is a normalized supply, once they feel like their balance sheets are normalized balance sheets, everybody brings their prices down because they want to compete again.
Yeah, and what I want from you is I want you to tell me what that trigger is that you
know. When is that day?
What is that day? And I know you can't.
Let me just text you on that day. I'm like,
is that day?
Today is it. We're refining.
So we got a minute to go.
Oh, really?
Yeah.
Why do we do it? We need a 4-hour episode to talk about this.
We got a minute to go.
Yeah.
Leave people with a piece of advice and how to get a hold of you.
Biggest piece of advice. Call me for anything. I honestly, Jay and I, we talk about different topics, but usually when it comes to anything in your financial life, people who are talking about how and why they're buying their houses, they're making money on other houses. I'm like, why do you still have all this debt? I try to give people advice in their life where they actually need it, not just do a mortgage for them because I'm a loan guy. Right. So I want to give you always the best financial advice I can for you. I tailor every single client that I have the best I possibly can for their financial needs.
And if people are watching somewhere outside of there, can they still contact you?
Call me. Yeah, call me.
Give me your information.
So first of all, thanks for having me. Appreciate it.
Coming on.
My phone number, 919-612-0043. That's 919-612-0043. My email address is pfitts@advantagelending.com. That's pfitts@advantagelending.com. And I'd really love to help you out, talk finances, and see if I can do something in your life to help you save some money while I put you in debt.
Awesome. So. Thanks, man. Hey, everybody, this is the show. You know what I say to you. You had a lot of choices. You chose us. Give us a thumbs up on YouTube. That's always awesome. If you are listening to us via podcast, I ask you that what you would do is if you would give us a positive review, that would be fantastic as well. As I say to you all over the world, you know what that is. Ciao, everybody.